Hey everyone, and welcome to the European VC podcast. Today we have a bit of a special episode as I'm here alone in the host seat with two of our very esteemed guests, Toby, founding GP of Join Capital, and someone who will probably need a little introduction to any of you because we've got our good friend, Mr. Joe Schorge from Isomer Capital in the seat as well. And today's episode is different in another way as well because we're here to talk about Join Capital, but as you just saw, we're not only going to talk with Tobias as the GP that founded the firm, but also with their trusted LP, Isomer Capital. And remember, everyone, if you're listening in and love our show, do drop us a review, follow the pod, and subscribe at EU.VC.
This was their finest hour.
Tear down this wall.
It's more than just an alliance. This is a union of values.
United and determined, we can serve as a model for other regions of the world.
The nature of a problem requires a European response.
Europe is a story of new beginnings, new beginnings.
Let's start acting. This show is not investment advice, and the hosts of this episode may be invested in the funds and companies featured.
So let's kick this off, Tobias, and jump into the story of Join Capital. Tell us about it.
Yeah, hi everybody. Lovely to be here, and it's an honor. We've never done this, and so I'm very excited to do this with Joe, which is great because we go way back, as you can imagine. Yeah, so Join Capital is a company that we founded in 2015. We're a team of previous corporate venture guys and saw an opportunity to invest in what we now call the new industry. And 2015 obviously was not quite as it is today, or it was for the last 5 years. So for us, getting the firm up and running was quite a challenge. Nevertheless, it was possible for us to do early deals, find entrepreneurs that fit to our thesis. And yeah, we concluded a successful first fund and are currently on our second. And I think the original founding idea of Join has always been launching a fund that invests in a thesis or very specific sector thesis. And for us, that is the digitization of industry. This was kind of a novelty back then. It's now becoming a broader topic and there's more capital flowing in these kind of companies. But that was our original ideas. And Join, we called it Join because for us, it's always been a joint effort between entrepreneurs, the investors, and of course, the corporate customers, which are very important if you're running a B2B focused fund.
When someone says industry, I very quickly think about hardware as well. How do you think about hardware?
I think hardware is not to be neglected. In the future, there will be more and more hardware everywhere you look. As of today, we mainly focus on software companies. Some software needs a little bit of hardware to facilitate the software sale, and that for us is fine. But kind of the pure dominant hardware investing, we have not yet figured out really for us. We're open, we're seeing more and more, but it hasn't been really a priority for Fund 1 or Fund 2.
Now, Joe, we should bring you into this, and I want to hear from you how you got into this, the story of Join.
Well, ladies and gentlemen, cast your mind back to 2015. As Toby mentioned, I forgot the date, but I met Toby and Jan actually when they still worked for a large German corporation, and they had a big idea, and that big idea was, what you just heard. I also had a big idea. This was even before Isomer started, and I don't think you had the name Join, and I don't think I had the name Isomer, but we had these big ideas, and we found each other through the network. And you were saying, well, we're gonna create a fund focused on this area, and I said, yeah, I'm gonna create a fund too, if I can get it together. And I always smile because, as you said, Toby, if you think it's hard to raise a new fund now, try in 2015. it's gotten a lot easier, and Europe's gotten a lot more successful over that time. But why I got excited about the ideas behind Join, because I worked in manufacturing early in my career. I struggled as the head of tech for a group of engineering and manufacturing companies. I struggled with a lot of the issues that Join Capital's trying to invest in and bring solutions to: factory floor automation, logistics, and having spent quite a few years myself working on those problems and running software development teams addressing those problems, or buying software to fix those problems. You're basically trying to make old traditional companies go better, faster, and cheaper. And so when I heard the thesis for Join, I thought, yeah, I understand that problem. And I spent years working on that, and you haven't even started really scratching the surface of digitizing these things. I kind of agree on the hardware point as well, by the way. I think where hardware enables the business, then that's investable with a venture capital lens and target return. However, where hardware is the business, that takes you into more heavy capex and manufacturing, which is not really where venture capital can be effective and have the venture returns that we look for. Just to complete the story, so the happy part of the story is we did end up creating a firm called Isomer. Toby ended up creating a firm called Join, and Isomer was the first investor in Join.
I'd love to ask both of you, because it's a bit funny sometimes. And this goes to your corporate venturing background. And I'd love to hear the perspectives of both of you, how you think about that, because I always tend to kind of feel like there's some people in the VC industry that think less of corporate venture, or they say, well, they're not real venture, blah, blah, blah. And also, especially, and that's of course primarily coming from normal venture guys, that then you tend to then find a common enemy or talk bad about people that are different from yourself. So I think that there's typical group dynamics in that. But I'd love to ask you both, Joe, from the LP perspective, how, when you see a corporate venture team wanting to break out as a full-fledged private VC, how do you think about that and underwriting that team? What do you see that they need to show that they understand? And also you, Toby, when you were thinking back then, how were you thinking about pivoting out of the team, and how do you think about both managing the process, but also what were the differences? Where are the main risk factors?
I think there are very different nuances of corporate venture in the spectrum. Yeah, so I think you have, and there has been a lot of learning curve over the last 15 years as well. Yeah, so I would assume that corporate venture, as we knew it back then, probably has evolved quite substantially. Yeah, but I don't want to go. I think that'd be a different podcast going into the corporate ventures do's and don'ts. What I would say for today is, there was a reason we wanted to spin out, yeah, and that reason is early stage venture is really a partnership model. Yeah, you got to take the risk. You have personal skin in the game, and also be responsible for the upside. And those elements are rarely seen in corporate venture, where you're an employee in a big shop. Yeah? And so I think that's absolutely fundamental, because then you can stick to a portfolio theory and basically ride the wave till the end. In corporate venture, you invest mostly for strategic reasons. And as we know, corporate strategies, they change frequently. And that makes it very hard for a team trying to optimize a portfolio to stick to their initial investment thesis, and also probably get through times that are difficult and where the founders really need backing, and not just kind of them being disregarded because the strategy is not a fit anymore. Yeah, so I think those were kind of difficult things for us to observe, but there's one really good thing, and that became the really secret sauce of Join, and that is the awareness of the importance of being close to customers. Yeah, because if you invest in a big multi-billion organization, there are thousands of potential customers in that group, in that corporate. Yeah, and finding a way to really using them to your advantage to help the entrepreneurs and help in finding out the go-to-market and product market fit, that is a real skill. And that is really the DNA of Join. And that's what we retained, from everything. I mean, learning a term sheet, learning a cap table, doing deals, that's mechanics, and you can do that as well in a corporate setup than in a private setup. But like being able to understand how you connect the dots and make that asset available to your founding teams, that is what we retained. And that was the DNA and the basis of Join. And we even have just recently launched a program around this officially. We can talk about it in a minute. But if you do B2B, that's, I think, really what sets you apart. And that was the really good part. And we learned that really well in the corporate world.
And you, Joe, if you were just to chime in on this as an LP, seeing a team that wants to break out from a corporate venturing arm, how do you think about that?
Yeah, Toby took all the good points. So how do I add to that? Corporate VC teams, you first have to look at who the people are, where did they come from, what's their experience. That's always important, and do you have a relevance for the entrepreneur? What are you bringing to the entrepreneur? Because the minute you spin out, you lose your big brand. When you're a corporate VC, you have this big brand card that opens a lot of doors, and then you leave, and then you're who are you? With a card you invented last week. So the first question has to be, do you have a relevance to founders, and can you really bring anything to help them? Once you're out of that context. I do agree a lot with what Toby was saying. Corporations have the problem of changing their strategy every year or two. And that's at odds with the objectives of early stage venture, which is we're going to invest in a company and expect to be part of the journey for quite some years, because it takes a long time to build a company. So if you often see within corporate venturing, immediately from day zero, whether that's recognized or not, this conflict between the long-term needs of building companies and the short-term objectives that do tend to change in the corporate context. So what we look at, and we have backed more than one ex-corporate VC, but what you're trying to figure out is, okay, if you look at the track record, does that at all line up, or in part line up, with the thesis you're launching to go private, if you will? And what can I understand about what you've done that could inform the future? And we see a real mix from companies that on one end maybe haven't changed strategy a lot, have a long-term point of view, almost act like a commercial VC, up to the other end where companies are investing not for investment reasons as we think about it, but more for access to teams or market intelligence or other aspects. And that's the funny thing about corporate venturing. Often a lot of investments are made for non-investment reasons. They may not perform economically, but they do other functions. So it's a little bit more complicated to tease out, what were the investments you did? Why did you do them? How did they work out? And how can we understand them? But what I loved about the early days of Join and the thesis that continues today, it was partly informed by the experience, but it was also really focused on a problem in industry. And it's an identifiable problem. It's a problem where if you're a founder in that area, you need a certain set of expertise. And so I just love that joining up, if you will, between what they were thinking to invest in and what I understood about the market need. And I think that's a great recipe. For me, that's the exciting part. It wasn't that, there's a big brand there. The brand goes away and that isn't relevant over time.
Actually very relevant, and that's one of the problems, and that's where we've been super naive when we left, is access to capital. This is probably for corporate venture teams something they don't think about that much. How do you raise money if it doesn't come from the mothership? Yeah, and that for us was a big that was a problem. Yeah.
Yeah. Then you realize that dealing with the executive team of of the corporate was actually not as tough as dealing with LPs that haven't yet committed. Joe, you gave us the perfect segue to dive deeper on the thesis of Join, and Tobias, really, I just want to set the context by saying that you've now more or less closed Fund 2, which is 100 million euros. And I just want to hear more about your thesis, more about your strategy, what makes you different. And then, of course, as always, Joe, jump in to give us the LP perspective on all of this. But Tobias, take us away.
No, absolutely. So the way we see this at the moment and for the last couple of years where it started is there are significant challenges in the world. Obviously, we hear them every day, we see them in the news. But if you drill down into this industrial sector, there's really three things that keep people awake at night. One is decarbonization. So I think it's a massive challenge to kind of decarbonize the way we produce, the way we organize supply chains, logistics. So the price for carbon will increase, and people will be penalized if they don't bring this down. Now it's tightly linked to energy cost. So the more efficient I can do stuff, the more I can keep my competitive advantage, and the more I can even keep producing, maybe even here in Europe. So that's another issue that people are facing. And lastly, and as it's becoming a real problem, the shortage of skilled labor. So here, if you go to the big automotive factories or even to machine building companies, they would love to produce more. They don't find the skilled labor to do it anymore. And so for us, these three trends are really what we mean by the neue Industrie, and these are kind of old problems that can be solved with software. And I think nowhere else in the world you have a density of real high-tech and academic clusters where they spit out engineering talent that is capable of solving these problems with individual niche products. And that's really our thesis, finding more the engineering talent, maybe the academic talent, and write tickets, 2, 3, 4 million initial check in late seed or early A rounds, and help them define and craft the go-to-market strategy. So that's our approach. And we do this all over Europe. So our portfolio spans from Helsinki down to Lisbon. And as I said, our secret sauce, or our edge, as we call it, is that we have raised money from family offices and obviously from some fund of funds, but mostly from family offices that still own and keep operating a business. And so in these businesses, we have people identified that we call them the Join ambassadors. And these are chief digital officers or chief transformation officers, and they are our direct link to the shop floor. And so before investing in any given company, we can get real life experience and feedback from people who have the problem, who are looking for solutions, and who can evaluate the solution at hand. And that is a real winner, because the entrepreneurs love it, because we don't harass their existing client base when we do due diligence. We bring some new people to the mix. They give us the time to do so. Worst case, they get customers, but no investment. We still stay friends. And so that's and we can do this really well because we have that real thesis and sector orientation. And that's the ambassador program. We launched it on our portfolio day just a couple of weeks ago. I think it's going to go out publicly tomorrow, and that's a key differentiator for us, really. And if you talk to a founder in Lisbon or even in London, where maybe the density of industrial customers is not that high, they see this as a real advantage. And that's how we also get into deals outside of Germany, because we can bring them and onboard them here really well.
I remember talking to Sebastian about this program, and that was before it was called an ambassador program. So first of all, it's something you've been doing forever. It's been ingrained into your fund. Now it's then given a label, which I'm sure helps for marketing purposes. But I'd love to ask you, Tobias, if you could dive a bit deeper into the mechanics of this, because it's not a short process, right? It's not 3 weeks that you spend or let the founders spend with the LPs. It's actually it's a quite lengthy process in many situations, as far as I remember.
Luckily, we've never been exposed to this market where we were asked to deliver term sheets in 2 weeks, and luckily these days are over, as far as I'm concerned. But you're right. I mean, it takes dedication, and it takes also a little bit of will from the founders to work with us. But that's something we're looking for. We're looking for someone who wants to also build that relationship and also wants to incorporate the feedback, maybe even for the better, of the company. And so it's not that it takes forever, but if we have this kind of, after the first filter or first pitch, we have this deep dive approach to going really deep on a company. And within 3 weeks, we aim to really gain the significant feedback. Maybe then a pilot project or something takes longer, but the initial feedback is enough for us to inform our decision. And so we don't have to go dating for a year to make an investment. But oftentimes where it worked really well is we already engaged with the company before they even thinking about fundraising. So we met them at a demo day, or we got introduced by some business angel or someone else. And even though they're just raised maybe their round, they're not even thinking about fundraising, we asked them, hey, would you mind maybe pitching this to customer XYZ? And we kind of starting to wrap our head around it already way before. And that worked really well. That's how it worked out for our last investment in Munich, company called ModelWise. It was really like a pass for us a year ago. But we kept in contact and we showed it a few people. And as they kind of developed it and we gained more feedback, we were then very quick, actually, in making the decision to invest. That relationship for us is crucial because we're dealing with highly educated, highly skilled people. They're sometimes probably among the top 10 people in their field. And it's really hard to challenge them on the subject matter. So for us, kind of the ROI perspective from customers is really the only real thing we can test. And that's why we put such an emphasis on it, and that's how we do it.
Joe, when you hear that the LP base is an important part of the value add of the firm and they're incorporated part of it and so on, how do you, as an LP coming in with pure financial motivations, then think about that? How do you diligence that this LP base is actually relevant, that they're actually working correctly, and that obviously Tobias and his team will have they'll be exposed to a risk of managing the relationship between having them as LPs, but also as partners around the value add, and then they have individual LPs have some stake, at least as a customer, into the companies as well. So that is fraught with a bit of issues if you don't know how to manage it well. Is that something that you thought about or think about when you look at Join?
I like the ambassador program a lot because I've worked on both sides of that table. I've been the guy in the company selecting the software products to optimize design or production or whatever, and I know something about the tensions of the in-house built product and the silo between one department and another department. So from my point of view, if you must have a champion to bring in an outside product quite often in companies. So this is beautiful. This is the way that Join can really add serious value. And by the way, we do the same. We have quite a few corporate LPs. We've had joint meetings in the Join office with a large group of Japanese executives talking about how can we bring, and then it's actually Isomer's LP looking through Isomer, through Join to products. So in that sense, we're quite the same. We work with LPs in the same way, which I think in the early days of Isomer also was a surprise to LPs. Like, really, you can connect us to solutions and products and so on. And that arises out of our own corporate backgrounds at Isomer. So we are having the same mission there. That's really aligned. And then we're both fund managers. So that's really like none of it matters unless we build great products, get a customer base, and drive good returns. So in that sense, we're the same. I don't really see a conflict there, but as I guess Toby said, it's hard to figure out, and you must spend a lot of time with people. Are you going to be an investor in the fund, or are you going to be strategic? Or I hope you're going to be both, but that takes a lot of time, and I guess we both learned the hard way. You just got to knock on a lot of doors, have a lot of conversations, and try to understand what is the objective of the potential corporate partner or potential LP, and can we help? Can those objectives line up? I guess the final thought I would give, what we're always trying to figure out is not only can we help, but can we find a way of working that's compatible with the founder, with how we're working? So obviously, we're not having a meeting every week with every LP, for example. We can't, right? So there's a level of engagement and an expectation setting up front that has to fit, because at the end we're all managing funds, and that has to be the primary job. So this strategic collaboration has to have a context that works, a way of working that works. So I'm always doing a little testing. Oh, how do you operate your team? How do you think about engaging with the founders? How do you think about the products? And you can figure out ahead of time, is this a context within which we can work and drive mutual value, or not?
Maybe, Andreas, just to clarify, the ambassador network, there's no need to be an LP to be part of it. Yeah. So I would say the ambassador program is probably 1/3 LPs, 2/3 non-LPs. Yeah. So it's really not a requirement. Yeah? And the reason we now institutionalized it is exactly what Joe just said. Yeah. I mean, in the beginning, it was my partner, Sebastian, Jan, and myself knowing a bunch of people, oftentimes probably people quite high up in an organization, and it just doesn't scale. I can't call the CEO every other week and say, hey, we have this really cool AI company. What do you think? And he's like, Toby, I love you, but sorry, I can't deal with this right now. Yeah. And so we needed to bring it one level below. And you find the ambassador whose actual job role is to know and to feed the stuff in. Yeah. So we're not always pulling. Yeah. So also someone else is pulling the information in. And we even have a dedicated team member now. Vanessa joined us. She's running the platform. She's running the ambassador program. And it's her dedicated role to kind of cluster these people, matchmake, and tell the investment team when we look at a deal, hey, you should really show this to XYZ. Yeah, and you need a dedicated resource to that, because the fund manager, you can't do this. You have other things to do. Yeah. And in terms of your question on the conflict of interest, there's really none, because we don't raise the money from the corporate. Yeah, we raise the money from the owner, which is basically the family office. So the engagement then with the corporate, that's a windfall profit. That's just an argument for the owner to say, look, I invested here. There's something good for you guys too. Yeah. So make the most out of it. But there's no conflict. Nobody's P&L is kind of in between.
Yeah. So you've never seen that play out. That makes a lot of sense. I'd love to dive into your thesis around the new industry, or the neue industry, as you say. You're German, so of course you're using neue. I love to ask you, because so industry is obviously manufacturing of products, hardware, all that stuff, and then it's taking that digital. But does it matter at all whether they're producing cars, or producing windmills, or a third thing? Or is it the actual process of just producing?
No, and I think that's probably what we not mean by neue industry. Yeah, so the term is actually much broader. Yeah, so for example, you have a chemical industry. Yeah, you have an automotive industry. Yeah, but maybe you have also an industry in construction. Yeah, or you have an industry in logistics, supply chain. So don't only think manufacturing. Yeah, manufacturing is a large part of it, but we're not a manufacturing tech fund. Yeah? So we also invest, for example, in the digitization of property, which is very similar to a factory. There's a lot of sensors now. There's a lot of potential to save energy or bring HVAC consumption down or whatever. Yeah. So Neue Industry is not just manufacturing. It really is it includes transport. It could also include vertical SaaS applications within large companies. So it's a much broader spectrum, and I'll tell you why. Because if you're doing a very narrow, even narrower than Neue Industrie manufacturing tech fund, you're running the risk of being too exposed to a very specific trend. Yeah. And maybe in the return expectation, this may unfold late or may never unfold or be small. Or I think the risk for us would be too high. Yeah. And I don't think the market's developed yet to produce outstanding companies only in manufacturing tech. Yeah. So for us, it's important, and our fund one was a real outperformer in DPI because we had 3 really good exits, and those were companies that were already kind of using existing technology, well adapted to use case, and that tracked well, and we were able to sell them at the peak of the market, and it provided a lot of DPI that then fed our fund two. And so fund two, we're replicating that strategy. So we're seeking for the really crazy deep tech companies that are reinventing the world. We're super excited about those, but we'll also invest in a guy, for example, who's disrupting a multi-billion oligopoly in an elevator maintenance service. Yeah. And obviously he's not reinvented the wheel, but he found a really good business model and capturing a lot of attention. And we can probably sell that company in 5 years' time and return the fund. And so from a portfolio construction perspective, we really have to construct something that pays back the money. Yeah? And that is also important. And we're diversifying not only on a deal-by-deal basis, but also a little bit on the profile and the type of company we want to put in that basket of Neue Industrie.
I'm curious, Joe, because, and this will probably be our last question here, Industry 4.0, because it's present in my mind because I'm from Denmark, and Denmark is doing a lot in Industry 4.0 and robotics and so on. I'm going to a conference here in September or so only about that, bringing VCs that only focus on that. And I'm curious because Tobias just said, well, it's a bit narrow for us. I think you get too much exposure to to just one sector if you do that. Is that your view as well? That would a robotics or Industry 4.0 pure focused fund be? We're not quite there yet in Europe.
I guess this is just a point of definition, right? Because the front end of all manufacturing is design. So you forget there's a giant engineering department. So how's a company winning? Often it's winning on having a better product. Well, you need to build that product, but you also have to have a top flight engineering department. And if I look at the Join Capital portfolio, I see an awful lot of design and engineering tools, specialized CAD tools, getting those CAD designs in an automated way into the machine tools. So for me, we're saying the same thing. Part of industry is even from the front end marketing. How do you find human resource? You've done an HR company, right? Specialized within that space. So if you think more broadly about the industry, I guess your mind may jump straight to the building of the product, but actually you need so many other things. And having worked in this kind of company, that for me is just part of the normal definition. But can I give Join Capital a badge of honor, which I don't think I've ever told you, which I didn't realize. We had our Isomer Capital annual meeting a couple of months ago, and so we were reporting to our investors what went on in 2022, the good, the bad, the ugly, and so on. And we realized, diving deep into the data, that of all the 70-odd funds we've invested in so far, there was one group that gave us back more cash in 2022 than any other, and that was Join Capital. And I don't think told you that, Toby, so shame on me. But that was, really impressive at a time where exits were slowing down. If you talk to the big world of LPs, they had great distributions in 21, a bit of 22, but the thesis that B2B kinds of companies, they have longer sales cycles, but revenues are sticky. So in other words, it takes a long time to get your product into a big company, but once it becomes part of the business process, it has a long-term value generation. And that means also that in theory, exits should be somewhat less related to the capital market cycle. It should be more related to, are you bringing value to your customer? So I just want to say well done to Join Capital that, again, it's not a metric we particularly think about, but we kind of, analyzing all the data and we realize, wow, well done. And isn't that the end goal of a thesis like yours, that you create long-term value, and that should be somewhat cycle proof, if you will. And at times when all the remember, stock markets are crashing, all these high-flying consumer plays are now toast, and there we are having some great exits on the new industry side. So anyway, I just wanted to slip that in somewhere today, and that's the power of a diversified portfolio, and the power of putting your customer up front, creating value for them.
Very cool. Congrats, Toby. I think I think that's quite a feat.
And now, the quick fire round. Quick fire.
Now, on that note, let's go to the quickfire round, where I will ask you 3 quick answer questions. Tobias, first I'll ask you to give us the advice that you would give to your own 10-year younger self.
So I'll keep this within the fundraising and VC kind of note. And my advice is, in the fundraising, try to find people like Joe who are dedicated to committing, and not spend so much time with people you're trying to convince that venture is a good thing. Yeah, because that's how I wasted about a year time. And you should really spend the time with people that actually want to commit, and they're just looking for the right deal. Yeah, and so everybody I talked about in this group of LPs and family office and industry, they are not your early backers. They come in once you're done, basically. Yeah, but you really need to spend time with someone you can craft the business with. Yeah, and that's why Joe's role's been absolutely, we could not have done it without Joe and his team. Yeah? And that's what everybody needs to find in the beginning before you even get going. And then you can build on that. And I think that would be my advice. Don't try, you can force the sale of your LPs. It's not going to work. Yeah? You need to try to spend time with the people that really want to allocate.
Totally agree. It's a very difficult thing to learn and evolve over time, because everybody loves to talk. It's free learning. Hey, Toby, tell me about this aspect and that aspect. But you have to figure out a way to determine, are you actually a potential investor? Are you allocating capital to the space? Because it's so vital in those early days to find those groups who are really going to do something, versus those, maybe they come later, but they're loving to talk to you for a learning rather than an investment.
Now, what are your top tips for emerging VCs who are fundraising across Europe?
Think about your fund like a product. We don't do that enough. VCs are always advising founders on their product. Build a better product. Think about what value does it add? What are the key features? Who wants to buy it? What are the margins? Apply that same logic to your fund. Why does the world need another fund? There's already too many funds. You need to come up with a really strong answer for that and keep building competitive advantage. And 2 quick ones. Plan for the downside case. Think about what can go wrong. And we all are optimists and think about the upside. Plan for the downside. Think about it. Try to put provisions in. You may never need them, but fortune favors the prepared mind. And finally, it's going to be harder than you think. So hang in there, because perseverance is the only thing that wins.
And now, Tobias, give us yours.
Yeah, along these lines, my advice would be, forget the fund in the very beginning, because that's going to take a long time. Try to find a way to maybe even do deal by deal. Group around your thesis some people that want to give you money, not for a fund, but maybe for a deal. And then go deal by deal and find a way of generating a little bit of management fee when you do that. Because in venture, the problem is before you're really operational and you had your closing, there's no way for you to generate income. And that could be very hard on you and your family and everything. And we've been there. We made that mistake. It was very painful. And so I would say find a way to do some deals while you're building the story and crafting the fund. I think that would have been my advice. Because if you have deals, you're not selling a blind pool, which is also a very different thing. Yeah, so people can look and understand what you're talking about with real examples.
Absolutely. And now for 30 seconds each, what's the most counterintuitive thing you have learned in venture?
Counterintuitive, try to get to a no decision as quick as you can. and that applies on the fundraising side, but also on the investment side. And it's counterintuitive because we all work very hard to make things work, to make things possible, to make things happen. But if you really believe that time is your most precious commodity, you need to really do everything you can to get to the no decision. In other words, we're not going to evaluate this investment more because it's just not fitting, or we can't spend more time with this potential LP because they're not allocating, they're not working. And the quicker you can streamline your process, also building your team to get to know, that actually will pay you back and be very helpful, and spend your time on the yes.
So for me, in VC, you always think about investing and giving money and investing more cash. I think for me, the most counterintuitive is that it's not always the best answer. Yeah, more money, not always the best answer. So we learned some lessons where we should have probably invested less, and figured out product market fit better, and bootstrap longer period, and kind of be more stingy with the money, for the benefit of the founder. And that's sometimes very counterintuitive, where everybody thinks I need to raise big piles of cash. And I think that for us, especially in our vertical, has been very counterintuitive learning.
Thanks, guys, so much for joining us for this episode. It was amazing to have you on, and it was amazing to join the VC party at SuperVenture. All right, everyone. If you enjoyed this episode of the European VC podcast, drop us a review, follow the pod, and subscribe at eu.vc.
I am David, the LP Syndicate Lead, joined by my dear co-host, Andreas the Hype Man. Thank you so much for tuning in today, and can't wait to see you all out there.
This was their finest hour.
Tear down this wall.
It's more than just an alliance. This is a union of values.
United and determined, we can serve as a model for other regions of the world.
The nature of a problem requires a European response.
Europe is a story of new beginnings. New beginnings.
Let's start acting.